So continuing on to chapter 3, we're going to look at fundamental interpretations made from financial statement data. And basically the idea in this chapter is, we're going to look at a couple ratios and trend analysis, and this is an introduction to our discussion this week as well, is how basically can we look at a company and understand its, first of all, current condition, and second of all, what's driving its profitability. In other words, what's creating the profitability of this company? How is it performing in terms of returns to its shareholders? In other words, how well is it doing in creating profit for its owners and generating income on the assets that it has deployed? So basically, we can look at rate of return. I mean, at the end of the day, companies do well. I mean, investors do well when they invest in companies is when their amount of return over the amount of the investment is a rate. And we all know, of course, for equity markets, I think the average over years and years is about 7%, but investors generally expect, first of all, a positive return, and over long term, around 7-8% return, and that's what management teams are looking to hit. And in the fashion industry, in our management world here in the Northeast, that's what management companies are looking to hit in terms of their rate of return for investors. Now, how does that translate into what you got to do in your company? Of course, for the equity of the company to increase by 8%, essentially you need to add in an income of 8% of your equity to your as income to the year-end equity. I mean, that's something that could appear simple, but you can also look at it as return on investment, which is basically when you invest money, your net income over the average total assets, and that could be powerful. This is like, how well are you using your assets to generate income? And this could be powerful because you may want to learn. A lot of companies use less and less assets to generate higher incomes, because then it's showing higher income per lower asset. So this ratio can actually be very much increased by lowering the assets that you have while generating the same income. And that can be interesting because it means you got to use less capital to generate the same income. Return on investment is basically very interesting. It looks simple, but it's very interesting because it's basically your net income divided by sales times sales over average total assets. So basically, the first one is margin, which we're all familiar with. So it's net income over sales. Basically, how much of every dollar are you keeping as income in every sale? So if you sold something for $1.15 as income, the ratio will be there 15% on the first piece. Now you're selling coffees for $1. You're keeping 15%, 15 cents for every coffee you sell. Now, how much of that is you turning over? So it means kind of like in terms of sales, how quickly are you turning over those assets? In other words, you don't want to be holding too many assets. You don't want to be having 300 coffees on inventory and selling 200, for example. Say you have 300 coffees in inventory, but you sold like 900. Then you're making a lot, basically making a lot of coffee throughout the week. But the idea is, the more turnover you have, is the more times you get to keep that 15 cents per dollar. And it's basically, the turnover illustrates how fast you're turning over these sales compared to how many assets you're holding. So this is a very interesting equation, and it's basically showing you the efficiency with which the firm's assets are used in the revenue generating process in terms of turnover. And margin emphasizes from every dollar of sales revenue, some amount must work its way down to net income. So this is an equation that basically shows you To improve your profitability, return on investment, you may want to keep more cents per dollar. In other words, you find it a more efficient way to produce your coffee or increase your quality of your coffee, so you increase the price. And you can also sell more of these things by either opening more coffee shops or having more customers inside of your coffee shop, and then you'll see higher turnover. And the key is to how do you do that with not having, and also deploying a certain amount of assets so that your return on investment is dependent on how efficiently you're utilizing your assets, as well as how well you're keeping an amount of every dollar sold in your net income. Return on equity, another one that we will use later on in our discussion this week, is net income divided by average stockholders' equity, and this shows basically how much of income per stockholders' equity is being created, and that's the return on equity. In terms of liquidity, which was important the last 10 years with the financial crisis, not too long ago, the current ratio is very good to look at because it shows you current assets over current liabilities. How able is somebody to meet their immediate obligations and make sure that they're liquid?